Hi, Dominique, and welcome again to another edition of the week ahead. And as people can see, I'm wearing a short sleeve shirt, and so the weather is getting a bit warmer. And without a bad pun, I would say the heat is on the Fed right now, and probably on the markets as well. Certainly, this has been, again, a very kind of tough week, certainly for markets and risk in general. So let's kind of like dive right in. Maybe a quick summary of your views and any kind of changes in your views at all over the past week.
No change in the big view. Terminal rate much higher than expected, possibly close to 8%, and recession on the horizon. No change on that. In fact, the FOMC members are starting to agree with me. One reason why the markets were performing so poorly this week is probably that finally the FOMC members admitted that it's not going to be possible to stabilize inflation without a recession. Now, of course, they used nice, words from central bankers. So I think Chair Powell talked about, what did he say? He said the process of bringing down inflation to 2% will include some pain. But even more interesting, we have Williams, the president of the New York Fed, who is a dove, who spent his whole life, his whole career is built on estimating the natural interest rates, R-star. So a dove, if there is one, who said that the landing of the economy would be softish. So no longer talking about soft landing, but starting to show nuances, in the direction of a hard landing. And that's the bottom line is that when you have that much momentum in the economy, and when you've had what Ken Rogoff calls hyper stimulus, not possible to kill inflation without recession.
Right. Are you, just quick one, are you surprised that yields are not higher? I guess people bought bonds because they said, they were looking to park their money somewhere. And, when the equities, crypto, whatever else was really selling off, now high yield as well.
So yes, and there could be several things going on. So one is a bit of a, flight to safety reflex, because what's happening is, as Bilal told us many times, when you move to an environment with higher rates, so a structurally different environment, you have all kinds of dislocation. And we've seen two so far. So the first one is tech. So all those companies that had no cash flow or no profit getting repriced. The second one is crypto, where obviously there was a lot of imbalances. And by the way, to me, as an economist, what's happening in crypto is fascinating, because it reminds me of a wildcat banking in the US in the 19th century, that you had, banks popping up all over the US and promising to have the equivalent of the stable coin. So, IOUs or certificates issued by the banks that could be redeemed at par. And then it turned out that, the cash or the gold that the banks got in exchange of those IOUs was used for all kinds of purposes. And when people wanted to actually redeem the IOUs, hey, there was not
enough cash, right? Yeah.
Not enough gold or cash. So it is fascinating. But I don't think it should distract us from the fact that, we are witnessing of the beginning of a very deep revolution, not just in finance, but in the whole economy. The blockchain is really going to change how, it's going to lower transaction costs in many domains. So I can understand how painful it is, but at the same time, it's absolutely fascinating, because we are seeing the beginning of a completely new era. And
Right.
by the way, I'm not long, I'm not long crypto. So people, I'm not talking my book here, but there is really something going on which is going to transform our lives very deeply.
Yep. Yep. I think, myself and Bilal definitely agree with that. And, short-term movements in Bitcoin, Ethereum, and ever does not really detract from kind of long-term fundamental work that a lot of blockchains or problems are trying to solve. And as people have talked about in the past, in many times, a lot of real work has been done when you've had these kind of crypto winters, and people have just really focused on, obviously you need money to hire developers, pay people and stuff, but for companies that have the resources, they take those opportunities to kind of really kind of work on building real solutions or addressing real problems in the world. And that has progressively improved I think the overall kind of crypto market or what blockchain does. But through these spikes of huge euphoria, you obviously have had, a lot of crazy things, just like we just saw with the UST and Luna, and maybe continue to see more things. And I guess Bilal's other point was, when you see a big pullback from liquidity from central banks after such an incredibly stimulative environment for a long time, there's going to be like fissures that come out that people just don't know, and there always will be. There always be way too much credit. Could be something coming through private equity or alternative lending, or or something. So that I think we just need to kind of obviously be on the lookout for. So
definitely. And so the question is, what comes next?
Yeah.
So you mentioned private equity. Some people are starting to talk about, a bubble there and some sharp moves in valuation, but these are private markets, so it's not going to be that obvious. As an economist, I guess the thing that worries me the most is probably corporate leverage, smaller companies like SME, corporate leverage, which is not on the radar screen, but could have a big impact on employment and growth.
Yeah.
But this, I don't think will come up until, close to the end of the year or possibly next year. But definitely we are not done. So that could explain why long-term yields are not moving more. People are a little bit scared. Another reason is that they expect the recession sooner than I do. Some people are talking about Q3. The definition of a recession is 2 consecutive quarters of negative growth. The negative growth we got in the first quarter was a fluke.
Which I think everyone agrees.
Yeah. So recession in third quarter would mean that this quarter and next quarter are negative. I doubt it. I actually think that killing growth could be a challenge for the Fed. I published this week a note on wealth, showing that for 80% of Americans, wealth has not gone down because increases in real estate values have offset the decreases in the
stock holdings,
stock and bond markets. So, the Fed has had this very loose policy on the assumption, they've been repeating for the past 10 years that it's much easier to kill inflation than to increase it. I suspect they are going to discover that it's actually more difficult than I thought to kill inflation.
Right. And in reality, it's difficult both ways because they weren't really, for years they were trying to create inflation, and then when they finally got it, it's much more difficult. But what was the point you just? I was going to laugh at, some other, let's say, other kind of quasi research companies, or who talk about this incredible age of exponential growth, and now in 6 months, they're changing, saying that we're going to enter a recession, or we may already be in a recession right now, which kind of reinforces the fact that hopefully our clients kind of understand this. Like, our number one goal is to help people make better investment decisions over the short, medium, and long term. It is not to freak you out. It is not to tell you that we're in the exponential age and we're going to see insane growth in all these technologies and crypto, and then 6 months later tell you we're going to enter a horrible recession. In fact, we're already there, where the numbers don't play that out. And so small comment, I just wanted to get that out. So so coming up, speaking of growth, what's the key things you're looking for in the week ahead?
So the key thing is really the retail sales. So I'm looking at the credit data because back to your point, we want to help people make better decisions. There are three things to help them: data, data, and data. So I'm trying to be as data driven as I can, while of course having in the back of my mind a broad model of how the economy works. And the data that I'm really focused on at the moment is non-housing household credit data. And it's really going up. And what's going on is really two things, or three things. One, household have been deleveraging since the GFC, so they have plenty of room to borrow more. Two, because of high inflation, real rates on household credit are actually still fairly low. And three, income, labor income is stagnating. Real wages are slowly but surely falling. So what's pulling real household income is employment growth, which is still, robust, but the lower income household are basically having to borrow to keep their consumption going despite the inflation. So you're seeing this strong growth in credit, and I suspect this could make for a positive surprise in retail sales this week. Basically, the demand side of the economy is having a second wind because of these borrowings. Yeah.
So your idea is the wages are not keeping up with inflation, but households have been deleveraging for the last kind of 5-10 years. So there's space for them to put leverage on within not a totally crazy context. And that's what they're doing right now by increasing their credit.
Exactly.
Yeah. So it's not like a symbol of like something horrible happening.
Absolutely not. Absolutely.
Right now that they have the ability to do it and they're doing it.
Exactly. It's more, the horrible or the negative side, if you will, is that it will make it that much harder for the Fed to bring down demand, because, the Fed dirty secret, or maybe not so dirty and not so secret, is that they have no impact on supply. So when the supply of side of the economy contracts, all the Fed can do to limit inflation is to contract the demand side. And that's what they finally admitted to this week.
Right.
So in that sense, because they fell behind the curve, what's happening is that real borrowing rates are low, and they are going to have to hike aggressively to catch up. But there is another data point which is really important this week, which is real estate data. So you have some real estate data every week, and usually I don't pay much attention, but here is why it's important. Because in terms of the Fed slowing the economy, there is only two places where it can do that, two places that are interest rate sensitive: residential real estate and durable goods. Now, residential real estate, again, the Fed is so behind the curve, and that real mortgages are actually negative, even though nominal mortgage, the 30-year nominal rate is above 5%. And then you have a cushion of excess demand, which you can see by the level of inventories, which are twice as small as before the pandemic and before the unwinding of the household bubble in the mid 2000. So we are getting an update on this number, and I will be watching it closely as an indicator of what's happening to excess demand.
How much do you think that, and I don't have the numbers offhand, but this idea that, well, investors, institutional investors, not like, like the movie where, somebody has like 6 homes and they're just speculating, like institutional investors have become a huge part of the residential real estate market in the US. How much are they impacted, or that also will take time? And is it more fragile because of that?
So definitely, that's a big change since the GFC. Their share in ownership has gone up. It's about, in terms of flows, it's about 20% of new demand, but the data is published with a 1-year lag. So it's likely that over the past year, it's actually much more than 20%.
Yeah.
But yeah, I mean, it's made the real estate market much more financialized, because before you had basically, families like ours buying a house and staying put irrespective of price fluctuations, because we are all structurally short real estate, right? We all need to get a home. And now, by contrast, you have big investors that are driven by financial consideration, not consumption consideration. And so, with as long as the cost of funding is low, and then you have this 20% annual rate of capital gains on their investment, as long as you have this huge gap between the cost of funding and the appreciation of their asset, of course, they will continue to pour money. But
so everyone's real estate deals are going to show, 20% IRR because, let's say you bake in 10 or 11% and you have funding rates at 4.5, 5, and serious leverage, like this is eventually that will play out negatively, but
exactly,
it will take time for that to do. Plus, there's not enough people doing the construction workers, there's not enough material, it'll take time to build all the stuff. Yeah.
Exactly. It will take time, and it will require much higher interest rates than we have now, which is, where I draw comfort of my close to 8% terminal rate. But once it happens, it's going to be brutal, because it will happen much faster than, if the sellers were families, because, as I said, families need to stay in their home. So what has been going on is that, thanks to the Fed, a super loose monetary policy, the residential real estate market has become financialized. And it means that prices are going to be much more volatile, that, there are going to be a lot of issues with excess leverage. I would say the saving grace is that this excess leverage and financialization is going to be limited to institutional investors. Yeah. Households still have strong balance sheet. So we're not going to have a repeat of the GFC, where you had forced sales of household underwater. Yeah. That is not happening this time around. But we could well end up with a bit of oversupply.
Yeah. Yeah. I haven't talked to you about it, but something we can look into this week, and I was going to start looking at is especially with, interest rates came back. Obviously there's a long-term, a little bit over the last kind of 2 weeks. But I think most people are, including the Fed, as you said, are coming around to your idea that most likely rates are going to have to be a lot higher and we're not talking about some crazy steep curve. We're probably talking about like the whole curve going up in parallel, just, so maybe one of the really interesting trades is that volatility is not that high on these kind of deep out of the money, like say pair swaptions or puts on TLT for equity focused or wealth managers. This could be like very interesting and very underpriced trade. And maybe that's something that we should kind of look into. I'm just looking at volatilities on like 1-year options on TLT, which is the 20+ year treasury.
I love it, Andrew. I'm all for it. So definitely something really.
Fine, let's do that. Let's make sure, and we'll talk to investors, and please, anyone feel free to reach out. Anything else that people should be looking at this week outside of the retail sales and the housing data?
So if you are interested in US politics, there is an interesting primary coming up in Pennsylvania. And I am half European, half American. I'm a dual national. I'm so fascinated by the diversity of American society. So briefly, let me sketch it out to you. The ranking member, so the most senior Republican on the Senate Banking Committee, Pat Toomey, is retiring in November. So there is a Republican primary to decide who is going to be running for the Republican Party in November. And we have 3 candidates, absolutely fascinating. So the first one, who got former President Trump endorsement, is Dr. Oz, who is a TV celebrity. He has this sort of pop medical
He's
show.
He's where I get all my nutritional advice from.
Oh my God, I'm worried.
Just kidding. Yeah.
So he was a front runner. He had President Trump's endorsement. Against him, we have the former CEO of Bridgewater Associates, David McCormick, who didn't get Trump's endorsement, but has tons of money. And so
he's very conservative. Did you know, was he there when you were there?
Yes, absolutely.
Nice
guy.
Yeah.
Nice guy. But so they are putting enormous amount of money, both of them. Negative ads are flying out. And meanwhile, you have a challenger without money, without Trump's endorsement, who happens to be a Black woman who is surging in the polls and may well win. So to me, this is a fascinating example of diversity, dynamism, and also, the US society has big issues with people left behind, globalization, and neither party is doing a good job of representing these people. So you have challengers like that lady coming to the fore. So it will be an absolutely fascinating primary to watch. It's
in a super crucial state too.
Super crucial state, and what is at stake for investors is basically Trump becoming again the presidential candidate for the GOP in 2020.
But all three are supportive of Trump, right?
Yes, but you know that the famous swing voter in the suburbs, soccer moms, they are not all that keen on Trump. And so if the Republican could find a sort of less colorful candidate, they probably get better chances in 2024. So they have, I'm sure the Republican establishment has very mixed feeling about this primary. And so it's about basically the influence of President Trump on the party. He had 2 high-profile primaries where in West Virginia and Nebraska. One of his candidates lost, one of his candidates won. So the bigger story, besides how crazy and interesting American society is about whether President Trump still has enough influence on the party to impose himself as presidential frontrunner.
Okay, awesome. A lot to think about. As always, everyone, we hope everyone's enjoying everything we're doing at Macro Hive. We work hard. We really, as I said, all of us really think about how best we can be there, how we can be balanced, how we can be thoughtful, because we understand people's hard-earned money is, it's not something to play with. And it's really something to try and get good quality advice from. And that goes from a retail investor to the most sophisticated kind of bank traders and hedge funds. So good luck everyone this week.